everyone. So welcome to session 2. We're going to be talking about OPEB in this session, and we will get started in just a moment with our moderator, Kate, kind of kicking us off here in just a minute. We'll get started.
Okay, good morning. Can you hear me?
Good morning. Yes, we can.
Hi. Great, super. So welcome to session 2, everybody. Thank you for joining us today for our OPEB and Pension Insider Summit. This is session 2, and we are going to have today's session hosted by my colleague, Dr. Richard Fry. And so I'm going to turn things over to him. He's going to be our MC for the next little while.
Thank you, Kate, and good morning or good afternoon to all those on the call. I'm going to initially introduce our panel, talk a little bit about their backgrounds and whatnot, and then we'll get right to the agenda. So I'm Rich Fry. I'm a retired superintendent of schools from Pennsylvania, 17 years as superintendent in Pennsylvania. I also was an administrator in Northern Virginia. So 33 years in public education, working with PARS over the last 5 years. Also with us in support on the panel is Maureen Toll. She's Executive Vice President, National Consulting at PARS. Maureen's been a specialist in governmental post-employment benefit trusts to fund both pensions and OPEB, as well as other supplemental retirement plans. She spent 17 years working as a key aide to government officials at the federal, state, and local level, including Congress and 2 state legislators. She currently works in 10 states with multiple employer programs in Texas, California, and Arizona. Also with us is Kathleen Von Aken. She's the CFO at the Unified Government of Wyandotte County, Kansas City, Kansas. Kathleen oversees 70+ department staff members for all finance functions, including budgeting, financial reporting, payroll investments, debt issuance, economic development, finance administration, grant management, countywide property tax administration, and motor vehicle registration. She does a little bit of everything. Previously, she held finance department positions with the city of San Mateo, the city of Stockton, and consulted for various municipalities. Also with us on our panel today is Dennis Mullins. He's the managing director and senior portfolio manager at U.S. Bank. Dennis is a managing director and senior portfolio manager, as I mentioned. He currently manages close to $1.5 billion in assets. He has over 30 years investment management experience, including 10 years developing customized investment solutions for banks' Sections 115 trust clients. A former senior portfolio manager for BlackRock and director of institutional investments for Fifth Third Bank, Dennis brings a unique combination of experience, both as a CBA and a CFA, and has benefited many of his clients through the course of his 30+ year career. Also with us is Kate Cannon, and she kicked us off today. She's a senior manager of the Eastern region with PARS. Kate has specialized in PARS' other post-employment benefits, OPEB trust practice since 2014. Her client base includes over 100 Section 115 trust clients in Massachusetts, Connecticut, Rhode Island, Pennsylvania, and South Carolina. Kate is one of the core team members in the establishment of regional and statewide trust programs. Those included in that include the Plymouth County Trust Program and the Rhode Island Interlocal Risk Management Trust OPEB program. And our last panelist is Dion Papathote. She is a senior manager of the Texas Public Agency Retirement Services with PARS. Dion joined PARS in 2000, oversees client services, sales, and marketing for our company in Texas, and manages service calls to all our Section 115 trust clients within the state. Before joining PARS, Dion worked as a registered principal, registered representative, and managed marketing and administration of plans for the American Financial Services. So we have a very, very diverse panel that is schooled in exactly what we're going to be talking about this evening, or this afternoon, which gets us to the topics of today. I'm just going to briefly touch on what we hope to get to in our panelist framework. Who's funding it, who is not, what do we need to know from reports and studies? Pay as you go versus pre-funding, how do we analyze it, which is better for my agency? What are the impediments from moving from pay to go to trust funding? How much do we need to contribute, and where do those funds come from? What have local governments done recently to pay down OPEB liabilities? Is it the right time to become more aggressive or conservative with investments? And is your trust trustworthy or compliant? Where does that fit? So that's our framework. I'm going to queue up questions to our panelists. If our participants would like to ask a question, you can go into the chat format, and I will either interject those as we're going through that specific discussion, or we will talk about those at the end. So without further ado, we're going to get started to our baby steps to start funding your OPEB trust. And for those already involved, how you move forward with that. So as I just covered, we have lots of people joining us today from all over the country. And again, welcome to all of you. So Maureen, Dion, and Kate, in your travels and consulting with your clients in the various states you work, can you share what you're seeing as the current landscape in OPEB and retiree healthcare?
Thank you, Dr. Fry. I'll just give an overview of what we see around the country with OPEB, and it varies quite a lot. There's some data from the public plans database, which is run by the Center for Retirement Research out of Boston College. And I think they do it in conjunction with the Government Finance Officers Association and NASRA, the National Association of State Retirement Systems. They do it for pension and OPEB, as well as Mission Square Research Institute. And I won't go into detail about some of this, but what we see when we look at the map of the United States is that OPEB is much more prevalent in certain areas of the country. So, starting in the East, where a number of the panelists are, in the Northeast, New England, all the way down, New York, New Jersey, into the mid-Atlantic, Pennsylvania. There's quite a lot of OPEB liability. We also see it in the upper Midwest, places like Michigan, for example. And then in the West, California being, a state where there's a lot of OPEB liability. And so in other states, it's less prevalent. In some places, non-existent. So it's not national in nature. From these statistics, from looking at thousands of cities, towns, townships, counties, school districts in this database, and OPEB data is harder to come by than pension. It's a $1.3 trillion liability. And the vast majority of it, over 2/3, are with local, not state, because state governments also have liabilities. The average is, according to this, is 37.75 million. If you go to the next slide. So some of this data also reflects actuarials from a while back, but this is what we would typically see overall across the country in terms of OPEB funding. Unlike pension, there's no requirement under GASB 75 to fund, and governments are paying catch up because there was no GASB requirements to value and account for your liability until went into place in 2009. So they're playing catch up. And so this is what we see by different public agency types, and it's very similar. On average across the groups, it's 4.8% or roughly 5%. And that's what we see from other studies. And a few more studies just to give you an idea of what the research shows. If you go to the next slide. So back in 2013, the Pew Charitable Trust looked at this, and then they updated the study, and they looked at 61 cities, and they found that at that point, 6% of them were funding their OPEB liabilities versus 74% were funding their pension liabilities. And then they did a follow-up, and there was increased funding, but not significantly. You could see 10% had funded 10% or more, and 11 had funded 29%, only 8 had funded 30%. And more recently, Standard & Poor's has looked at this, and they said the largest cities in the United States they're about 13% funded, and also at the state level, they're significantly underfunded with OPEB. What we find also is that, in Pennsylvania, where Dr. Fry's from, is a perfect example of this, that the cities and suburbs tend to have more significant OPEB liabilities and be more likely to fund it. So for example, if you look at Pennsylvania, which was one of our larger states, the Philadelphia, Pittsburgh area, those, you know, in the East Philadelphia, in the West Pittsburgh, you see it that a lot of the governments have OPEB liabilities, but the wide swath of the middle of Pennsylvania, nobody has OPEB liabilities. So rural areas, smaller local governments tend to have less. School districts in Pennsylvania all have OPEB liabilities. They just don't tend to fund it to a significant extent. So I think Pennsylvania is an example of that. Go to the next slide. So that's basically a picture of what OPEB looks like across the country from the research and data, Dr. Fry.
Thank you, Maureen.
Yeah.
Anybody else from the panel have anything to add in regards to really the national picture?
I guess I would just echo what Maureen has shared, and having spent most of my time focusing on OPEB up here in the Northeast corridor of the United States, it is very regional specific. Looking at New England, Massachusetts, Connecticut, Rhode Island, heavy OPEB obligations are seen. Massachusetts, especially, as it is a requirement to provide retiree health care. But when you go up into Maine, New Hampshire, and Vermont, it's more specific to the size of the agency, the smaller cities, school districts, but the smaller municipalities tend to not be offering the benefits, so the liability is a little bit lower.
Yeah, and Kate, we'll be looking a little later at what states have been successful where a great number of their local governments are funding places like Massachusetts and Rhode Island. You know, we see it in Virginia and places like that. And then we see some laws like in New York where they have significant OPEB liabilities, but they don't have a law in place to allow for OPEB trust. And then other states, particularly in the Southeast and even including in the West, places like Oregon, they don't allow you to diversify your investing. We have clients in South Carolina that can't invest in anything but what they would with funds outside of the trust. And so that is a disincentive. So some of the characteristics, the legal characteristics, and are an impediment to funding. But we will talk about some of the success stories and what went on in those states that encouraged funding of OPEB liabilities.
So we've heard a little bit about the history, the footprint of OPEB, and what we're going to get to. I'm going to put this out to the entire panel. As you see in the slide, pay as you go versus pre-funding. You know, as an agency, how do you figure out which is better, which is the better approach for your agency? So open up to the panel in that regard.
Sure. There are several benefits to pre-funding, including the contributions to the trust are considered assets on the financial statements. The assets can be diversified for the potential of a higher rate of return, and addressing these obligations can favorably impact your credit rating. Pre-funding can hedge against healthcare inflation and also longer life expectancies. And it means for future taxpayers and employers that they won't bear a disproportionate burden of the cost. Funding in the trust cannot be diverted for any other uses, and pre-funding helps offset the financial impact of GASB 75.
Other thoughts from the panel in regards to pay as you go versus pre-funding?
To comment on that GASB 75, that is a more recent version of GASB 45, and it's requiring now for OPEB to be on the balance sheets as opposed to just a footnote. And so it's elevating the prominence of OPEB on the financial statements now. So we've saw an uptick with GASB 75 coming in. We saw a lot of funding start to occur, trust setup, when GASB 45 was originally implemented. So, and these have been some of the big impetuses to doing it, the GASB rules.
So Maureen, in that regard, we talk about OPEB pre-funding, and it seems from some of your early slides that many agencies are not addressing their OPEB liabilities. It really makes me wonder what are the barriers to entry, and with those barriers, once we identify them, how do we address them and how do we mitigate them to make sure that we're moving in a healthy direction in that regard?
So I can hop in here. So it's I've put together some thoughts. When we go out and meet with agencies, sometimes there's a hesitation, a bit of a confusion as to what OPEB pre-funding is all about. So it's understanding what it means to pre-fund and why you would pre-fund. And it's, as Dion kind of covered a few minutes ago, it's all of the benefits of setting aside these assets to address your liability. One of the key things is to keep that promise. When you hire your employees and you promise them retiree health care, you want to keep that promise, and pre-funding allows you to do that to help bring down those costs. Maureen touched on legislation. There are some states where you have multiple steps that you need to take in order to pre-fund. Here in my home state of Massachusetts, we have statutes that agencies must adopt, and multiple things they must adopt so that they can have an OPEB trust. The state of New York does not allow for pre-funding. They do not have any governing rules. South Carolina, we work with agencies that are prohibited from certain approaches to investing, fixed income only. So state regulations and statutes can be a barrier to entry. Your decision makers, your governing boards, as a CFO or finance director or treasurer of an agency, you are really tasked, and that's where we assist, with educating the influencer, the decision maker. Oftentimes your selectmen, your city councilmen are from the private sector. They don't really have an appreciation of what OPEB means to your bottom line. The perceived cost. I've met with people, and the idea of putting a trust in place, they don't understand the all-in cost. They're afraid that it's too much. Where when we speak to them, oftentimes it's better to spend the money to put that trust in place, and there are low-cost options of how to put a trust in place. Better to spend that money now so that you can pre-fund and address those rising healthcare options in the future. Lack of money. I've met with agencies that have said, well, if we set aside some money, we'll put it aside, and when we have quote unquote real money to invest, that's when we'll start a trust. Well, I would say you should put that money that you have initially setting aside. If it's that 50,000, if that's 100,000, that money should go straight into your trust and start being counted towards that liability. So that's really important. So there really isn't a lack of money. Other issues that seem to be taking precedence. We had a boiler burst at town hall. This school department wants to put in a new ball field, things like that, so that those dollars are being kind of spoken for. But it's really looking at this and talking and educating all the decision makers and all the players that these long-term liabilities do need to be addressed sooner rather than later. And then I'm sure Dion and Maureen will agree with me. Oftentimes when we talk about GASB, trust being GASB compliant, the one thing that sets people a little bit back on their heels is the idea that the funds have to be irrevocable. Irrevocable is a scary word out there to people. I won't be able to access those funds. But you can access the funds when they're in an OPEB trust, and you can access them for anything retiree healthcare related. So the trust assets are irrevocable for anything else, but for those healthcare costs, they are.
Thanks, Kate, for walking us through the barriers and how we can really work through those. And I think it's important now that we maybe get an example of someone that's going through the process of establishing. So Kathleen, you're in the process of establishing OPEB trust for your agency. Can you share your process with us and really what were the legal issues you needed to contend with, and was an RFP required, and how did you address some of those 7 barriers that Kate just summarized for us?
Yeah, thank you, Dr. Fry. So the unified government is a consolidated city, county, local government. We have an operating budget of around $400 million, and we have 2,300 FTE. And back in 2020, our outstanding OPEB liability is $132 million. which represents 13% of our total outstanding long-term liability. So in evaluating all our long-term liabilities, which include municipal bonded debt and accrued absences for compensation, pensions, we figured out that the OPEB liability is the only long-term liability where we could actually quickly affect a substantial reduction by creating an OPEB trust. And so, because right now our OPEB benefit program is on a pay-go basis. So to create the trust, we needed to first calculate what our annual contribution needed to be in order to be fully funded, say in 20 years. And so in order to have that data in order to advocate for creation of a trust, we engaged GovInvest, and they gave us the tools to undertake this analysis. The software provided us with the ability to do what if scenarios and to provide information very quickly. And the team was great to work with when we were implementing the software or the tool, but also in creating that analysis and helping us to convey, what is an OPEB and why a trust would be beneficial to our governing body. They helped us with the presentations and the materials. So the conclusion of our analysis was that if we contributed 100% of our actuarially determined contribution, which we figured out was about $5.5 million a year, we would reduce our OPEB liability from $132 million down to $57 million, or like a 66% reduction. So that's going to greatly improve our balance sheet and will greatly reduce the fixed cost financial position indicators that our credit rating agencies closely monitor. So there's a lot of benefits to that. So the most challenging I found is that part in implementing this trust has been engaging or garnering the support of not only our chief executives on the 9th floor, as we call it, of City Hall here, but also employee groups, and more importantly, the mayor and elected officials. And so what I did was, it's taken me about a year to get to this point, but we looked to ensure that the Kansas statute allowed for the creation of the trust. And we found that there's only, as far as I know, there's only one municipality in Kansas that actually has a trust, and they created it back about 10 years ago or more. And so I think at that time, Overland Park, Kansas actually introduced legislation so that in statute, we are able to have a trust, which is great, because they mentioned earlier, some states don't have that. And then also we engaged a couple of attorneys to confer with them to see if in fact we can diversify our investments, which we found we did. So we made sure that we legally were able to do this. And then we reviewed how the trust, I reviewed how the trust should be created and administered. We've been putting together a trust agreement, and we decided on whether we should hire a third-party firm to administer the trust for us. Should we have a trust administrator, trustee, and then investment advisor, or what have you? Or should we do a bundled approach with various third parties such as PARs? So we evaluated all that information in terms of the administration. I wrote a white paper to discuss what is OPEB and how a trust would benefit our unified government. And it's about an 8 or 9, 10 page document that is kind of lays it all out so that anyone who wants to know about the OPEB trust can read through it. I also investigated funding options, because that always came up, and tried to figure out where can we find money. Since I'm the CFO, I know where all the money is. So where can we find money to fund this trust on an annual basis? And actually, I came up with a couple options, one of which is budget neutral and relatively painless. So, I'd be happy to share that if you have any questions on it. Then following that, we conducted a whole slew of meetings with senior executives, and just to answer any questions they had and make sure that they understood how it works. And then I met one-on-one with each of our 11 elected commissioners to explain how it works and to garner their support. And I think we're there. So in the future meeting in June, we will be moving forward with their approval for a trust agreement. And in the meantime, between now and June, I'm doing what I'm doing is an informal request for proposals for various third-party agencies like PARs. so that they can submit proposals, because the total amount of the trust administration I found falls below our procurement threshold. So we don't need to do a formal RFP, just a kind of informal request from third parties. And in order to include that firm in our trust agreement documents that the governing body will be adopting in June, hopefully. This summer, we're going to be also forming an OPEB advisory committee that'll be appointed. The members will be appointed by our county administrator. And that advisory committee is going to be tasked with providing us guidance on investment direction and funding policy. And so once all the policy and investment policy is adopted, we'll proceed with beginning the trust. And hopefully by the end of this year, we'll have it funded and we'll be able to reflect the reduction in the liability on our financial statements for 2022. So, but this has been an effort that I began about 3 years ago. It's been a real uphill climb, because much of it has to do with educating officials and garnering support. So,
Kathleen, you mentioned there a bit at the tail end in regards to a quasi RFP or an informal. Where do you did you find a place to get support for developing the RFP, even though it was a bit informal? We had a question in our Q&A in regards to, is anybody out there have an RFP that'd be willing to share? What supports did you have in regards to putting together your RFP, say 2 years into your process, which is what it sounded like?
Right. So what I did was I got on the internet and found a bunch of RFPs from different municipalities across the country and pieced it together. And in my research, I put that all together. I also got some information from various third parties to kind of, to do it. So, yeah.
Okay, thank you. Let's look at the process a little bit. As you heard Kathleen walk through it now, you have your decision makers on board, which is essentially where she's at. What are the steps one should take in setting up the OPEB trust itself? What's the do's and the don'ts that folks on today's call should be aware of as we get to this point? What's next?
I think the very first thing you need to do is you need to put a trust in place. I've met with a lot of agencies, and I think Maureen can echo this as we've traveled to different states, where people think by simply setting money aside, they have checked the box that they have an OPEB trust in place. So what you need to do is you actually really do need to go out and put a proper declaration of trust in place, adopt that per your state statutes and the standards that you have there. And you need to look and have a robust trust that's going to meet all of your needs, and then put together a funding policy, an investment policy, and develop and work with a investment manager who can provide you with a diversified program. And I've taken a moment here just to put some side-by-sides to show you the difference between a budget reserve account and a trust. And an important thing to look for a trust is that a trust can be fixed income or diversified investing. It needs to be GASB compliant. So that's that irrevocable word I spoke about a few minutes ago. It needs to be dedicated for retiree healthcare purposes only and protected from creditors. And it needs to have it should have a corporate trustee to help share your fiduciary risk. And Maureen coined this phrase when I first met her, always think about it. Is your trust trustworthy? And making sure all of that. So what I said a moment ago, no executed written document, there's no trust. Make sure it's GASB compliant. Always make sure that those assets are held separately from other assets for the city, that it's for the exclusive benefits of the retirees and the employees and the beneficiaries, and that they're able to be properly diversified.
Okay, so let's take that leap. We got the OPEB trust in place, documents are signed, and really I have to ask the group, which comes first, funding policy or investment policy? Once we have that in place, which one is our next step? Funding policy or investment policy?
I'll vote investment policy, but I'll see what my colleagues say.
Certainly agree with that.
I think we tend to see pension funding policies more than we see OPEB funding policies, just in my experience. I don't know what you see in Texas, Dion, in that regard. Sometimes they want to leave it a little bit more flexible and not put in writing a funding policy.
Exactly.
Okay, so if we start with investment policies, and that's the approach we take, what's really the base to a solid investment policy? What does that look like?
Well, I'll take that one. And let's talk first about why we want a written investment policy. And it's really important to document the steps that we're following as we go through this, this process for a variety of reasons. We want a written document to show that we're being good stewards of this money. We want a written document to show that we're following best practices, that we've done our research, and we're taking reasonable care. The pension law area is very well developed, and there's been a lot of legislation and a lot of court cases over the last 50 years regarding pensions that help guide us in putting together policies. OPEBs are different in the sense that, as Maureen and Kate have pointed out, there's quite a few states that don't even allow long-term investing of OPEB assets yet. And in that sense, it's kind of like, the early stages of the lifetime of retiree healthcare plans. But we can follow a lot of the lessons that have been learned over the years with pensions and management of pensions and investing pensions. And we can apply that directly to OPEBs. And using an investment policy is certainly one of those areas. So again, to have a written document that shows what we're trying to achieve, the steps we took, in getting there is certainly a level of protection for everybody, but it also just helps us to show everybody, all of our constituents, what we've been doing. The other reason to have a good investment policy is that there's turnover, and whether you have board members, investment committee members, town council, city council, hired employees, or elected, at large from the community, we're going to have turnover over time. These retiree healthcare plans are going to be here longer than any of us. And it's important to just document what we're trying to do. And an investment policy does that. And if it's properly executed, and includes, not just the investment elements and goals and objectives as I've listed here, but also put down a little bit of the history. When was this plan initially funded? What are our goals? It provides us with something to hand to new employees and new members of the oversight group as they come in. And, here, let me bring you up to speed on the history. This is what we're trying to do. And this is how we've done it. So once you put together an investment policy, you definitely want to put in the basic investment elements of it. And that includes your time horizon. These OPEB plans have a very long tail. We're looking in terms of 20, 30, 40 years for most of these funds. And that should help lead us all in the right direction as far as investment strategy goes ultimately. But it's important to put that down. Most of the groups that we're dealing with when it comes to investing OPEBs are responsible for short-term operating funds and then the OPEB. And we run into a lot of clients who are used to having very conservative investments, and that doesn't match a long-term time horizon. Funded status would be something to mention, again, because it leads us to, well, how do you want to invest these assets? Most OPEB plans are in the early stages of funding, and it's not uncommon for us to see a funded status level between 0 and 5%. Funding plans should be mentioned in in the OPEB investment policy. If there is one, where's the money coming from? Kate mentioned before, there are competing priorities, and it's good to know from an investment standpoint, are you going to be making contributions or not? Your risk tolerance should be spelled out. Your goals, very simply, what are we trying to achieve with these investments? Do we want to have a portfolio that's primarily in equities? Do we want to have less liquid assets that might be much longer term in nature? Things of that nature. You want to put this down in writing because it's a good exercise. It really forces us to make sure that the structure of the plan matches the goals of the plan and matches the risk tolerance and matches the time horizon. And it's a really good, kind of enforced feedback loop. We also want to put oversight in here, and I put roles and responsibilities. Who's responsible for what? Who are the various parties involved? Do we have an investment committee? Do we have a council? Are we reporting directly to, the mayor or the treasurer? We want to put in here what everybody's roles and expectations are. So there's I mentioned, a couple of reasons to invest these. Here's another reason, to create an investment policy. There's another reason that we haven't really thought about in a while to have a written investment policy, and that is that there are times when the investment world is really scary. And we look back on the investment policy and we say that this was a document that was created in a period of relative calm. We sat down and we thought about it, and we went back and forth with a couple of drafts, and we all reviewed it and marked it up, and here's our final. It's good to have take that time to develop an investment policy, because there will be times in the market when things are scary. And I don't mean like right now after the market's down 5.5% in the first quarter or, the year, and we're seeing some losses for the first time in a couple of years. But I mean, when there's an event in the world that really rocks everybody emotionally. And, thinking back to investment meetings I had right after 9/11 happened, it was a scary time. We didn't know what was going to happen next. We didn't know what governmental responses around the globe would be. The stock market was closed unexpectedly for a few days. There was an expectation that this might drive us into a recession, and it was a scary time. And there are meetings that I recall where we pulled that investment policy out and we said, remember, we wrote this investment policy when we were not in the midst of some event that really, scared us long term. And we need to follow that investment policy. So that's another reason to have that policy. It really provides you with a rudder in the water, so to speak.
Dennis, that makes great sense. And you talked about the strategies involved. And you mentioned a little bit about how the market's down a bit right now, but let's talk a little bit about trends, what you're seeing, and given the volatility of the markets and impact of world events, certainly not 9/11 kind of events, but some things that make our hair stand up a bit. What do you see happening? Are your clients become more aggressive or more conservative?
Good question right now. Clients are not really making a move yet, but clients are becoming very concerned about the markets. And let's just take a second to look at what's going on in the markets right now. I did mention the markets were down in the first quarter, and anybody who's got investments in the market, I'm sure, is certainly aware of that. We've got a very volatile day going on right now. The markets were down earlier, and now they're up. And it's really hard to kind of wrap your mind around what's going on in the market these days. And the reason for that is we've got a couple of long-term trends that have come to an end. And some new trends have been established, but we're also waiting to see what new trends will be the new normal going forward. So we look at the world, the major inputs to the financial markets as we see them are usually monetary and fundamental. And from a monetary standpoint, we couldn't be more busy right now. I've been in this business about 40 years, and for that entire period, interest rates have generally been falling. In the early 1980s, we saw short-term interest rates above 15%. You could get 14% on money market funds. Prime rate reached as high as 21%. And from that point until now, you could argue rates have generally been in a declining trend. And that's usually pretty good for the market. And it should come as no surprise that we've seen above trend returns out of the market for the last several decades. And we're forecasting below trend returns for the market for the next decade. And so we're really at a transition point. So interest rates are now rising for the first time in, depending on how you measure it. I mean, short-term rates have gone up a couple of times over that 40-year period, but we seem to be at the end of the very easy money, low interest rate period. Other countries around the world we're seeing central banks matching us with that. And so we could be in a real rising rate environment, which none of us have seen in our careers. So we're entering a new normal. At the same time, and it's still affecting really the liquidity out there, we've just seen in the last couple of years massive stimulus spending. And it is unlikely that we're going to see stimulus continue at the same rate for a variety of reasons. We're coming out of the COVID shutdown. We've seen a change in political leadership that is not likely to continue cutting tax rates. And a couple of other, we've got a midterm election coming up that may change the balance. So it's not expected that we're going to see direct stimulus spending, which is always immediately effective on the economy and the markets. We're not going to see that continue, at least at the rate that we've seen. Fundamentally, we're usually talking about earnings and profits and things of that nature. We are seeing earnings growth rates slow right now. They're still positive, but they're coming way down off of the COVID reopening. And so the market's getting hit from a couple of different angles at the same time. And, in addition to that, you lay on there the immediate effects of kind of an unexpected war in the Ukraine and all the uncertainty that comes with that, primarily for Europe. But there's a lot of unknowns out there, and the market hates unknowns. And so, your question was, are we seeing clients move? In the interest of time, if you could just go ahead and forward to slide 19, I want to talk about what we're seeing with, how investments are being done right here. Thank you. If we look at OPEB assets that are being invested, what we're seeing is that most of them are bunching around a fairly conservative investment approach. This chart really should be almost a mirror image of what you see here. We should see most of the assets invested in more of a capital appreciation approach, something more aggressive, because that matches the very long-term nature of OPEBs. Generally speaking, we should not see 30-year assets invested with 20 or 30% in equities. We should see those funds invested in portfolios that are more like 80% equities. And put that together with the fact that right now we're expecting lower returns in the future than we've seen in the past. That really leads us to the same conclusion. If you can expect to get, say, 5 or 6% out of an 80% equity portfolio versus 3 or 4% out of a moderate portfolio, you definitely want to have the discussion about increasing the risk of that portfolio in search of a higher rate of return.
Dennis, we had a question from an attendee talking about Robinhood investors and the ability to purchase small increments. Has that changed any kind of investment strategy or changed the market as you've seen it, in the last several years?
No, a simple answer, no. The volume is not great enough to really be having an impact globally on the markets. It's certainly fascinating and it's interesting to watch it's a fun kind of a event to watch. And there's some merit to the idea that we would love to see individual investors have every bit of the access to the stock market that large investors have historically had. And but as far as moving the needle, no, it's not. It hasn't been big enough.
Thanks, Dennis. And thank you on funding strategies and really update on trends. So as we move on and you know, we've got the trust in place. Now our investment policies in place. Our next steps really are funding the trust to address the liability. And in doing that, the initial contributions are so very important. Future funding is critical as well. But let's talk about initial funding. From the panelists, can you share some thoughts or experiences on where your agencies or agencies you work with are getting hold of that initial contribution? What gets it started, that initial contribution?
Sure, I'll take this one. It's important to start off by creating a funding strategy. In general, we have listed some funding options that agencies look to. Contributing the full actuarially determined contribution, also known as the annual required contribution or ARC, it's probably more commonly known as. We see agencies contributing the full ARC and then reimbursing the PAYGO at the end of the year, contributing the difference between the ARC and the PAYGO. We also see contributing a lump sum and allowing it to grow. And then we also see contributing anything, starting a trust. Something is always better than nothing. Just get started. Next slide, please.
I wanted
sorry, my
to,
screen's frozen.
this is Kathleen. I wanted to, you know, just provide a little, the idea I came up with. So, of course, we have an internal service fund for health benefits. And so we contribute contributions to the health benefits fund from the UG departments, from the city operating departments. And those are budgeted as if 100% of the budgeted positions are filled throughout the year. But in reality, you know, there's always vacancy savings because people quit and then it takes 4 or 5 months to fill the position and so forth. And so, so there's always a gap between that total funded health benefits fund contribution from the department and then how much actually gets deposited into the ISF through the payroll system. And so that gap is that all that funding is just sitting in fund balance in the operating funds at the end of the year. And so what we would decide in order to, we figured out that the difference between the budgeted and the actual over across all our funds is roughly $5 million a year. And so the way I'm proposing that we fund our OPEB ADC or ARC, right, is to basically use that budgeted amount that we are just letting fall to fund balance at the end of the year. And that was that budget neutral approach that I'm pushing for. And that really went well with the commissioners because, of course, you know, you don't have to change your budget. You just continue to budget as you have been. So just an idea.
Kathleen, I think what I see across the country most often is the put in anything, like just get it started.
Right.
Or right now we're seeing if they have extra funds, they're starting to put it in, or they've already set up what might be called an OPEB stabilization or just a side account. And then they're just sort of moving it over into that. I think that's the most typical way we would see it, or they find some source or they fully funded, say, their pension. And so now they're focusing on OPEB. I just had a client recently talk on that level. But one of the issues I think it's alluded to on the slide before is the GASB 75. In essence, you're only getting credit for how you're investing your asset allocation on, in essence, a part on the portion that's funded. And you're restricted to the municipal bond index. That was a slide before. I think we mentioned it. the municipal bond index. And then if your pay go, it's whatever the municipal bond index is paying. So actuaries are sort of restricted right now. And so sometimes if you're just putting a little bit of money in, you don't see that much an effect on your discount rate. Of course, your discount rate, the higher you get it, the lower your liability is going to be. I don't know if anybody's seen, like Kate, if you're seeing any in more recent actuarials, they're just not getting credit if they're much of a credit in the discount rate if they're not putting a lot of funds in. They're still significantly underfunded, and I know you're in parts of the country where they have significant liabilities.
What I am noticing that if you're below 10% funded, your discount rate is heavily tied to the municipal bond rate. It's really hard to move that needle. Then once, so Dennis and I have been meeting with clients, when you're getting up above a 10% funding, like a net fiduciary position, that's when you're seeing that discount rate improve, and it's based on funding. But I'm also noticing that in addition to the amount of assets in your trust, a funding policy in place is helping you with that discount rate. Consistency of funding, the funding year after year. We've had agencies here in New England that put in a significant amount initially and then didn't put any money following. So it wasn't showing that they were in the habit of pre-funding. It was a one-time fund. And then, as Maureen talked about, the diversified portfolio. So there are like 4 elements that really are going to go together and calculate that discount rate. But below 10% funded, you're going to be tied very tightly to that municipal bond rate because it is a blended rate.
So we have a question from an attendee, and this really is for Maureen and Dion and Catherine. Do companies like PARS help? We've talked about the OPEB investment policy and funding strategy. Does PARS help with entities developing that?
Mm-hmm. Yeah, yes, we do actually, and that's something that we in our role as consulting. We meet with an agency when we work with portfolio managers like Dennis, and we put together that investment policy statement. Then we spend time with the agency and see what are their funding goals, obviously to pre-fund that liability, but what is the pace at which they want to meet different amounts? Are they going to be able to, as this slide says, have a consistent line in their operating budget? Perhaps a percentage of surplus funds at the end of the year. They're looking at their free cash, as we call it here in Massachusetts. Maybe they can dedicate a revenue source. In Massachusetts, we have casinos and other things that have been developed here. So host agreements, surplus retiree healthcare costs, as Kathleen hit on. And then what's becoming very talked about is redirecting those pension contributions when you've hit fully funded status. I have a client that just passed a funding policy that said that they expect to be fully funded in their pension in about 5 years, and they'll be redirecting that money over to make OPEB contributions. So we really enjoy working with our agencies to help them put together that policy. And what I do is I always say to every one of my clients, always make sure that your funding policy is, one, achievable. Don't ever burden yourself with a funding policy you can't meet because your actuary and your auditor is going to ding you for that. And then know that it's a fluid and it's a living document. So what you may be able to fund and approach in 2022 might be a little different. You might be in a better standing in 2025, and you might be able to increase that. So, and we work with you to keep that document growing and developing.
I appreciate all your thoughts in that regard. And Dion, Kathleen, thanks for your specific thoughts in that regard. So we talked about the strategy. I think probably folks would like to know, at the end of the day, how much do you put in? And we gave some examples of where do the funds come from, but what are we seeing for the trends or approaches of how much to put in as we talk about that?
So I'm going to jump off, and maybe Maureen and Dion can jump in and share some of their experience with clients. With many of my clients, they're new to the pre-funding. It's what you can put in. So, and it's to get the ball rolling and get started. I've worked with districts that have come to the table with $50,000, but it's that slow buildup and the consistency. That's what I always encourage. And when money becomes available, if you have something that you can dedicate, like a fund source, I encourage you to do so.
As we we're getting close to the end of our time.
Yeah.
I wanted to just touch on trends that are out there. What do you see local governments doing currently to pay down the liabilities? We've talked about the level of the liabilities and how long out they run, but I think it's really good to talk about experiential learning and what's happening. So what have we seen out there that could help agencies we work with on how it's proceeding?
Well, I think the key thing is to put that trust in place and use, if you can, an economies of scale model. That's what we're watching groups come together, turnkey providers, so that you're putting those assets into your pre-funding. It's a shame to see agencies spend a lot of money putting a trust in place. Put those assets in the trust. So find an option that won't be too labor intensive and cost intensive in the startups. And Maureen and I have worked with groups that are joining together, regionally, associations, to put multiple employer trusts in place.
Yeah, that's where we see some, what I mentioned at the beginning, states that are really making progress on funding tend to have kind of collective multiple employer trusts, either sponsored by associations, sponsored by the state, sponsored by the retirement system. And we've seen that in a lot of states. Rhode Island, the majority of their local governments, although small, are all funding because they brought economies of scale. So I think somebody asked in one of the questions, they had, not a lot of money to fund. And so you want to look at these kind of economies of scale. I know Pennsylvania has something with their retirement system. Massachusetts has some regional ones. Virginia has been very successful with all their different types of public agency associations. The Mid-Atlantic, we've seen this a bit in Florida and then Minnesota as well. So those states have, where they don't have to all on their own set up a separate trust, and they just don't have scale for investments wise, is where we've seen some real successes in funding that are occurring. So look to those as well.
So as we wrap up, we sort of worked our way through OPEB, what it looks like, funding strategies, investment strategies. Is there anything that I failed to touch on that a panelist would just like to make an additional point at this time? Anything we missed?
One comment, because this is a pension and OPEB trust, I know we're running out of time, but one of the things that's different about OPEB is the benefit side of it, the vesting, unlike pension. And so sometimes that, and this is what they found in these studies as well, that plan sponsors have the flexibility to scale back benefits, and it varies from state to state. And so it's less of a potential maybe drain because they have more flexibility in controlling that aspect of it. And so that's why we don't always see OPEB, as the, focus that pension is, because of some of these structural changes. I just wanted to comment on that, on the legal, the vesting, and just the nature of OPEB versus pension.
Thanks, Maureen. On behalf of all our panelists today, thank you again for your well thought out responses to really help those involved in today's call. We're going to be sharing out the slides tomorrow, as Kristen said, in the email format. If there's any questions beyond that, please feel free to communicate at that time. You'll have contact information for those that served in that role. And we're glad to share with you today. And please be safe. And I think we'll queue up for session 3 here in a bit.